Hope fades Friday as stocks collapse. Technology sector enters a caution phase. Semiconductors, biotech, and retail groups are now in an avoid phase, which is a bear market. As is the Google, also known as Alphabet, it also has entered a bear phase or bear market. Bonds rally as fear of risk off for stocks grows. And I think gold is overbought, and it is being told by gold miners. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, March 28, 2025. As always, hit the like button, subscribe to the channel, share this video, make a comment, or ask any questions you like in the comments section. If you're a subscriber, stay tuned. We'll be covering various securities. You can see this time there's not that many because right now we're in this possibly transitional period where we're not yet out of the bull market, but we're not yet in the bear market. So there's some things going on. However, gold miners are definitely still on a buy signal, and we'll be looking at those as well. We'll be looking at some of the other securities like euro, Japanese yen, British pound, Bitcoin, crude oil, as well as some of the other ones. So stay tuned. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which you can see on this chart. This green, blue, red, and yellow lines. You can register on my site for them. Okay, so right now we're looking at S&P 500 chart on the daily time frame. So each candlestick, each one of those funny looking red and green candlesticks, squares, they are a day's worth of activity. You can change that in this time frame section. And right this instant, we're looking at stocks failing to make a decisive breakout above this blue support resistance line. I mean, we did do several days here above it. For example, there's a close above it on the 24th, and it was very hopeful. So this is actually the Monday of this week when over the weekend, overnight between the last Friday and the Sunday open, stocks gapped up on Monday, the 24th. However, by the end of the week, everything was lost. All of the gains were lost, and then some. And actually, we're now approaching the lows from the 13th of March. This could be better visualized on the 4-hour chart. So let's look at the 4-hour chart. So when I'm using 4-hour chart, I use what's called a continuous security. And in this case, I'm using this symbol, SPX 500 USD, provided by OANDA. And this is a index CFD, or contract for difference. It cannot be traded in the United States. However, it can still be visualized. So we're currently looking at that. So on the 4-hour chart, when we trade using my indicators, we use the middle two lines. We use this blue and red line. And up to relatively recently, everything was fine. We would have been buying it basically. But here back in the mid-February, 24th of February, and then eventually right there where I'm hovering on the 27th of February, we saw a breakdown below this red line. This by extension means that now this particular security on this particular time frame, 4 hours, okay, very important, which time frame you're trading on, has entered a new bear market. So we want to sell it short. We don't want to be buying it. Indeed, it would have proven extremely profitable. However, there is that 24th of March gap up. So this is a close on the Friday the 21st of March, and then the open was a few points higher on the 23rd of March on Sunday. There's a gap up. So this is obviously a very good indication, and people were very optimistic. And I was just not feeling it, I guess is the word. And when finally, on the Wednesday of this week, on 26th of March, we saw this big candlestick with a close below the red line, that is a signal for short-term traders on this 4-hour chart to sell this security short. Indeed, it was very successful if you heeded my advice, and if you have an option of trading it. You could theoretically trade it using options on S&P 500 ETF SPY. For example, you could have bought put options here on the 26th of March, and you would have been extremely correct, because notice that throughout the week, basically from Wednesday into Thursday, there was barely any movements. It was more like sideways movement, and finally on Friday, well, actually even on Thursday, we already saw a movement to the downside, this candlestick right there, and Friday today we just unraveled, completely unraveled. There was no stopping of selling. Selling continued from morning till night, from open till the end of the section, and we closed near the lows of the section. This is extremely bearish. We can see it on this chart. It basically closed near the lows. If you look at the daily chart, right there. We can also look on the weekly chart, and there is the weekly chart. So weekly again just means that each candlestick is a whole week's worth of activity. So we don't even look at anything until we're like lazy cats or fat cats. And some people that are very rich or big investors, very smart investors or traders, they only trade on Fridays. And in fact, they only trade on Fridays at the very last moment on Friday. The rest of the week, they enjoy their life and do nothing. Because actually, if you just trade on Fridays, notice that all you needed to do is just do it once in October 2023, and you did nothing. You just sat in the position until now, until very recently. So, but this is for longer term traders. So if we look on the weekly chart, this particular candlestick that we saw today is quite bearish. It is bearish for multiple reasons, which I will cover shortly. So here are the reasons why this candlestick from today is very bearish, meaning that it is not good for people who think the stock will continue higher, in this case S&P 500. So several things here. One, it is a red candlestick, meaning that the open is above the close. So yes, close is below the open. Obviously, it's red candlestick. So additionally, there is a tail out of the top. So it means that throughout the week, sometime the bulls, people who think the stock will go higher, try to rally the prices, but they failed. And by the end of the week, they completely failed. And actually, the bears, who think that the stock will continue lower, prevailed strongly. In fact, they prevailed until the almost very, very end of the session. There was a very tiny shadow at the bottom. You can barely see it. So it is a bearish candlestick. You can think of it as a funky looking shooting star, or it's just a big red candlestick with a resistance at the top. So this is a shown resistance. It means the prices just could not penetrate higher. In addition, it is a large solid candlestick which engulfed, it engulfed the real bodies of the week of March 10th, and the real bodies just means this red or green part of the candlestick. So it engulfed both the previous candlesticks, and in fact it engulfed the entirety of last week's candlestick. So this is what's called either a bearish engulfing, or you can also call it an outside reversal. So it is bearish, not good for bulls, no matter how you slice it. In other words, I think stocks will still continue lower, and at the very least retest these lows from March 13th, I believe. Yes, March 13th. So I think this March 13th lows will very likely be retested. However, if the March 13th lows are retested, most likely we will even continue lower towards this red support resistance line. Now, the red support resistance line on my chart implies caution, and I will show you several stocks that closed below it and then eventually closed even lower. So right this instant, we're seeing significant amount of selling on multiple time frames, as I just showed, and this is a not a good scenario, no matter how you slice it. I will also show that several of the major sectors, as well as major industry groups, as well as a very large stock in general, also are showing signs of risk off or bearish pressure, downward pressure for stocks. So let's look at one of those, namely XLK, also known as technology sector. So technology sector contains basically two stocks, Microsoft and Apple, and a very distant second is Nvidia, surprisingly. It's like at 4 or 5%. Microsoft is like 25%, and Apple is another almost 20%. So almost 50% of this technology sector is composed of Microsoft and Apple. Great. The important thing is here is that we're seeing caution. You see, this technology is a very important sector for the stock market because it is a like way back when Dow Jones invented his index, the important sector to the economy was like railroads or, I don't know, coal producers. Nowadays, we don't have, coal producers and railroads. I mean, we do use them, but they're just not nearly as important as, like, let's say, Microsoft or Apple. Everybody's using Apple devices, obviously, and many people are using Nvidia. Some people use whatever, Adobe and Salesforce, but not that many. So we're looking right now at XLK, and actually let's look at it from the point of view of the weekly perspective, and you will see what I'm trying to get at. So number one, notice that today, on the weekly time frame, on a Friday, this technology sector, a very important one, has closed below this red support resistance line. This is caution. Okay, caution, because the next step, if we get even lower towards the yellow line, it would imply a bear market, and that's the end of the bull market, and we need to think the opposite. And I'll try to show you what the bear market looks like in a few minutes. If we look at this technology sector from a longer perspective, we can see that the last time it was below this red support resistance line was in January of 2023, which was a while back. And you basically just, we had a couple of opportunities back in March of 2023, so 2 years ago, literally, to buy this technology sector. We had another small opportunity back here in October, in August, September of 24. But that's about it. Now, this is a very ominous sign, I guess is the word. So very close to an outright bear market. We're so close for XLK technology to an outright bear market. We're like 3% away. So easily we can drop that much there. So technology is a major contributor, technology sector rather, is a major contributor of the overall S&P 500. So if this technology sector fails and enters the bear market, I think the rest of the sectors could follow easily as well. In fact, I'm about to show you some sectors that are, or some industry groups that are already there. But before I do that, I'll show you Google. Here's Google, Alphabet, and it just entered the bear market. Okay, so it's currently in an avoid phase. How do I know? Again, I'm using my indicators. So just a few weeks ago, on the March 13th, Google entered a caution phase. by closing below the red line, and now today on the 28th of March 2025 it has entered, it went below the yellow line and entered an avoid phase, meaning Google has dropped into a bear market. Now I don't yet want to sell it short, because normally when we want to sell securities short, we want to see the entire market in a downtrend, in a bear market. So let me just show it to you what the bear market looks like, how it looks like in 2009. That was like the closest bear market, honest to goodness, long-term sort of bear market that many of us old people remember. Okay, so here's S&P 500 on January 2008. We have closed below this yellow support resistance line, and at that point we said, okay, we're done being in an uptrend. We want to sell the security short. In fact, let me look at it on the daily time frame. It's easier to visualize. Okay, there it is. Yeah, actually I already labeled it. Housing crisis, 2008, 2009. Okay, so I can tell you the exact day of when the bear market began because my indicators are showing it very precisely. So there's the date, it's January 8th, 2008, and the bear market started on that day. So at that point we said, okay, this security is no longer in an uptrend. We want to sell it short. And when do we want to sell it short? We don't want to sell it short immediately upon a close, entry into the bear market. Although you would have made a little bit of money here. Normally I want to wait for a bounce towards the red line. Okay, and yes, there it is. We had a bounce towards the red line. So for example, you would have been successful selling short on 4th of February. Yet again, a few weeks later on the 27th of February, yet again on the 7th of April, you could have entered here, and then yet again there was an opportunity to sell short on the 23rd of May 2008, and that one was very successful. Okay, and notice we made a lower low. Okay, again another sideways trade, and then collapse, into like just a total disaster basically. So and then finally it bottomed out here in 2008. Actually no, it continued, sorry, because it bottomed out around 666. I remember that number in March of 2009, and that bottomed out. So notice how big this move was. This was a 50% decline. So if you shorted it here by, let's say, buying puts, put options on the S&P 500, you would have been extremely successful. Finally, the final trade always fails because you have a setup, and then we have an entry into a bull market. So at that point, on September 10, 2009, we saw a new bull market for stocks, and stocks continued higher. And at that time, we want to start buying it. And yes, he would have been super successful by just buying it around the blue line. So this is what the bear market looks like. Now, why am I even talking about the bear market? Is, as I just described, we see major sectors such as XLK approaching the bear market. We see major stocks such as Google approaching the bear market, and we see several industry groups, which I'm about to show, also approaching, or rather already have entering a bear market. One of them is SMH, also known as semiconductors. So there it is. We're seeing, well, technically speaking, we landed on the yellow line. We can also look at more diversified semiconductors, XSD, but that one definitely has entered the bear market. But basically, we're there. So semiconductors have entered the bear market. Not a good sign. Semiconductors are what's considered a very risky, and more risky investments than just like, let's say, other stocks, like utility stocks, for example. So semiconductors are bought by investors when they think stocks are going up. There is risk on. We want to be buying. There's beautiful, bright skies ahead. And they're sold when they're thinking the opposite. Maybe we're about to enter a recession, or perhaps the new Great Depression. Could that happen? There's a chance of that. There is no way to tell, but the way things are going and the way the news are unfolding, I wouldn't be surprised if we enter a new Great Depression, not even a Great Recession. So semiconductors are currently in an avoid phase. Another super important sector is XBI, Biotech, ticker symbol XBI. So Biotech is a similar kind of situation as the semiconductors, because biotech firms are very risky. They quite often go out of business. They basically sometimes have like one or two products that may or may not make money. So it's a very risky kind of investment. It's a risk-on kind of investment where you think this, future is bright. Is the future bright when you want to sell it, when it just entered a new avoid phase? I would say no. So that is another kind of piece of evidence that I'm looking at. Semiconductors, biotech are in an avoid phase. And I think one of the biggest ones is, of course, the retail sector. So retail basically drives the United States economy, and it also has entered a new bear market. Avoid, right there where I'm hovering on, actually even earlier, in March, early March, 4th of March of this year, 2025. So we're currently looking at three major industry groups that are already in a bear market. That is not a good sign, and we will, anything is possible. We might pull out of this. Yes, it's possible that we might pull out of it, but it's, it is definitely kind of scary right now. Coupled with the fact that today, specifically today, because of all of the, investors usually think, okay, so let's say I sell stocks, and what do I want to do with that money? I want to at least, put it somewhere so that they work for me. So normally when you sell stocks, you put it into bonds. This is a 10-year Treasury note yield, okay? Yield and bond prices move in the opposite direction. So right now we're seeing that Treasury note yield is dropping, and especially today, notice we gapped down. There was a gap down in the yield, and it completely collapsed. So the yields seem to want to go down from here. We're currently at around 4.25% yield for the Treasury, the 10-year Treasury. The Federal Reserve most likely will have to lower the interest rates that they're charging right now because of all of the above issues that I just said, because we may not have much time before next recession starts, and usually Federal Reserve just does that. Of course, with our new administration, anything is possible, and who knows what they're going to do. Maybe they'll pressure the Federal Reserve to do something completely different. We don't know. As of based on the previous experiences, I guess, most likely the interest rates will be going down if the current trends continue as I just described them above. So this is a 10-year Treasury note yield that I just showed, and this is a 7 to 10-year Treasury bond fund, also with the ticker symbol IEF. That one is actually going up in price. So meaning that bond prices are rising, meaning that investors are pulling money out of stocks and putting them into bonds. Relationship between stocks and bonds is not exactly 100%. So this is S&P 500. I'm going to show you what is the relationship between long-term, okay, let's just do IEF, long-term, 7 to 10 year Treasury bonds, IEF. What is the relationship with the S&P 500? And this is a correlation coefficient. So you can see that it's not exactly opposite. It's sometimes negative, sometimes positive. So there are periods of time when bonds are moving exactly opposite to the S&P 500, and there are periods of time when they're just sort of doing their own thing. So right this instant, looks like we're about to enter a period where, or we actually already are, where the correlation is negative. In other words, if bonds go up, stocks go down. So this is what I'm expecting. I'm expecting bonds to continue higher, and the relationship to S&P 500 is negative. That means that most likely S&P 500 and stocks will continue lower from here. All right, that was it. Excuse me for the stocks, but I wanted to briefly touch upon Forex, and we're currently looking at the dollar currency index, ticker symbol DXY. It's not a tradable security. However, it's you can see what's happening with the dollar currency, with the dollar against other currencies. Up until relatively recently, dollar was in an uptrend. In fact, we hit 2-year high. We tapped, turned around, and continued lower and entered a new bear market on March 7th of this year, 2025. We're currently in a downtrend for the dollar. So when dollar is going down, normally gold is going up, and this is exactly what's happening. Gold is in an uptrend. Gold has just hit a new all-time high. So we have been trading gold. So this is what the trades would have looked, or what look like. We wait for up close above the blue line, and we just buy it. Okay, so you need my indicators basically. We'll go get them on the internet at MasterCharts Trading. Notice how easy it is to trade. We just buy and close above the blue line. So right now gold is it went from 2,000 to over 3,000 was the latest trade. Now this is XAU-USD, so it's a Forex instrument. Gold divided by US dollar. We can also look at gold futures, GC1 exclamation point. Gold futures are showing a little bit different picture. I mean, it's similar, but notice today what happened. We gapped up. Okay, so this type of gap to me looks like an exhaustion. Looks like it's the end of this run, at least for a little while. It could also be considered a breakaway. However, just the way this security has traded, it looks overextended, no matter how you slice it. And so we're looking like this gap is most likely going to be filled. We just don't know when exactly. And also, the other thing I was looking at is the gold miners, GDX gold miners. So gold miners today, when gold, gapped to all-time highs, gold miners today tried to do that, but then, sold off. So I'm going to look at this candlestick, and this candlestick to me looks like a textbook representation of what's called the shooting star candlestick. So a large white, large tail at the top, red candlestick, close near the bottom, very small shadow at the bottom. So meaning that the bulls tried to push the prices higher, the bears came in, pushed the prices lower. In fact, they pushed them so much that they closed near the lows of the session. So it looks like a shooting star candlestick to me. Perhaps we're going to see a move back for gold. It's definitely overextended, so a move down towards, at the very least, this blue support resistance line, which is currently at 2,800, is quite likely. which is about 10% down. A move of that magnitude towards the blue line would just imply that we're seeing a new buying opportunity, and so it would probably look something like this, new high and move towards the blue line and a buying opportunity. Of course, it also could mean a complete reversal, but there is no way to tell this until it happens in the future. So the only thing I can tell you right now is that it definitely looks overextended. Gold miners could be sending this warning by giving us this potential shooting star candlestick. All right, and that's it for this week's recap. I will now let you know how to find me on the internet. So please head over to MasterChartsTrading.com. Sign up one of the products. So I have 2 products and 1 bundle, and I just mentioned last week that I'm going to, within the next few months, will most likely be adding a 4th product, which will be stock ratings and more like official recommendations, I guess. Yeah, I cannot call them recommendations because I'm not a professional financial advisor, but we will call them stock ratings of some sort. And that would show, basically, like, for example, Google, currently is in a bear market. So it would have been, the rating would be avoid, okay? And a few weeks ago, it would have been in caution. And then the buy signal would have shown up in November. So things of that nature. So that is hopefully coming within the next few months rather. We're working on a script to basically go through the entirety of the stock market. There's thousands of stocks, and issue those alerts on daily basis. However, for now, you're already what trading indicators are available. So these lines in the chart, green, blue, red, and yellow line, they're available for TradingView.com. You need a free TradingView account. Sign up for TradingView account for free. Come back to my site, sign up for trading indicators, and I will open the door for you on TradingView.com so you can see my indicators. Complicated? No, it's not. It's really easy. If you don't want to do that, you can sign up for newsletters. So newsletters go out daily, and then one more time on the weekend, I send out a members-only video. So, for example, this week we'll be covering all of these various securities. The best deal, of course, is to get trading indicators and newsletters as a bundle. And if you get a yearly subscription, it's $49.95 per month equivalent. So if you buy monthly, then you will pay $59.95 per month. And of course, there's a free 7-day trial with all of my bundles, with all of my products. So you have 7 days to cancel with no charges. That's it again for this week's recap. Please let me know if you have any questions. Thank you for watching, and have another great trading week. Bye-bye.